folks. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute of Real Estate at the NYU School of Professional Studies. Thanks so much for joining us for the final iteration of the Capital Markets Leadership Series for the fall 2020 semester. We have had an absolutely extraordinary fall in terms of programming and have been joined by just amazing guests. Whether you're participated live or have watched the programs over the over YouTube on replays, altogether we've had about 40,000 people now that have either viewed live, participated in the sessions, or again joined us for both this series, Capital Markets Leadership Series, or the REIT series, which we had been hosting up until last week every Tuesday. Our students are just finishing up their last day of classes, are going into exams next week and early the week of the 20th and 21st. So our programming kind of winds down, but we will resume in earnest in January. And just like the fall, in support of students, whether they're at Schack or at institutions anywhere else in the country, really hosting the most robust schedule of public programs that we've ever had. Almost one every day this fall. But whether you're at Schack or another university, we want to make sure you have the opportunity to hear from leaders in industry. So please do participate and continue to join us. This particular series is sponsored by Arbor Realty Trust, and we're very grateful for their financial support of this program and others, as well as the Commercial Real Estate Finance Council, supporter not only of this series, but our partner in the CREFC Center for Real Estate Finance at NYU. At the CREFC Center, at our Urban Lab, at our REIT Center, our program on sustainable built environment, and our new program on social and economic inclusion, which focuses on issues of income disparities, disparities across race, across gender and gender identity. We have, again, a robust set of programming in the spring that I hope you'll join us for. A couple of things to keep on your calendar before you wind down for the holiday. CREFC's January conference, sort of something that I know that I make sure never to miss, and I would encourage folks to attend. Of course, we will not be in Miami this year, but we will be convening virtually on January 20th. Take a look at CREFC's site for that, crefc.org. The 25th annual REIT Symposium. We have about 50 different REIT CEOs joining us on April 6th, 7th, and 8th. We have our third annual Pride Roundtable, a special forum on emerging women leaders in real estate. So this is for folks that maybe have recently graduated or are just a few years out of college to help support their efforts in network building. And then finally in January, one of our first new initiatives, we're going to kick off the Young Woo Design Lab that will focus on broad thinking, whether with the lens of real estate finance, operations, asset management, cities, on how it is fundamentally that we will use space in the post-pandemic era. I am delighted today to be joined by my friend and colleague, Lisa Pendergast, for, again, the final session of the Capital Markets Leadership Series this fall. We were to have had Chris Lee from KKR join us next Thursday. Chris was very generous in allowing us to reschedule that for January or February because so many of our students are going to be in exams next Thursday. We wanted to make sure that that they had a chance to participate. Lisa is Executive Director of the Commercial Real Estate Finance Council. Today's session is going to be a little bit different from previous weeks, whereas we've had guests who've been able to opine on their particular space within the real estate capital markets, bank lenders, life companies, non-bank financial institutions. Lisa's really got the big picture view on what's happening with commercial real estate finance in her role in convening and really sort of serving at CREFC as the voice of the industry and engaging with so many different constituencies. As we jump in, please make sure to use the Q&A feature. Ask questions that you like, so they rise to the top, and comment or elaborate on the questions that are being asked. Lisa, thank you so much for joining me.
You're very welcome. Thanks for asking me. I'm honored. I've watched all the previous sessions and I'm in good company. So thank you very much.
Fantastic. I think everyone on the call knows of CREFC, but we do have students from universities around the country that may be relatively newer to the industry, have certainly heard of CREFC, but are less familiar with its exact role and function. But to kick us off, maybe that's just the right place to start. What is the role of the organization?
Sure. Thanks, Sam. CREFC's been around for over 25 years. We're an association that's focused on commercial real estate finance industry writ large. I was as I said, a member for, I guess about 25 years, almost since the very beginning. And to the extent that when I was on the business side, I found CREFC in its many iterations, CMSA, CSSA, to be a huge help for me in the work that I was doing as a research analyst. And to the extent, though, that I made relationships and friendships that I still have to this day. And so I always encourage younger folks to think of our trade associations, other trade associations, as to how they build bridges for you throughout your career. And at the end of the day, I now have friends who I've known for 25 years. And it's not just the folks you work with, it's across industry. It's, for me, I was on an issuing side, but I met servicers, trustees, certainly investors, and you really have that full complement of exposure to folks in the industry. CREFC has a number of member types. We have balance sheet lenders, the life companies, the banks. We have securitized lenders, be they CMBS or CRE, CLO issuers. We have the GSEs, Fannie and Freddie, and all of the folks who work with them. We have debt investors, be it on the loan side or on the security side, as well as rating agencies, third parties, private equity firms, and then really the whole slew of debt funds that emerged on the scene post the great financial crisis. So in many regards, we've expanded our membership, but at the end of the day, our goal, what is the association here for? It's really to promote liquidity, transparency, efficiency in the markets, in the finance markets for commercial and multifamily real estate. How do we do that? We do it through legislative and advocacy issues. I think one of the things that CREFC stands out for every day is the ability to set standards, develop best practices that really have taken hold and have lasted for as long as the association has been around. They continue to be tweaked and sort of improved, and yet they're here today, and they started 25 years ago, which speaks to sort of the veracity and the strength of these best practices and standards. So that's CREFC in a nutshell. I do say that today, amidst the pandemic, this is when a trade association shows its mettle. It is here for its members. It really has been a crazy period. And, at this point, I kind of look back and you think about all of the crises that the US economy and sometimes the global economy has withstood. This is different than all of them. I mean, they were all unique, but this is extremely different. So to the extent that we can advocate for our members with regulators and legislators, and more importantly, communicate not only with our members, but communicate outward to the press, to borrowers, to others, to understand what it is that we're doing as an industry during this pandemic.
And to reinforce one of the points you made, I think the first time I actually ever met you was when you were on the not you were not sort of yet at CREFC, but and we won't to save both of ourselves, we won't tell anyone how long ago it was, but it was the Commercial Mortgage Securities Association, CMSA, in those days, and I can't encourage younger members of the industry enough. Do take a look at the CREFC site as an opportunity to meet other like-minded individuals, build out your network. It really is an amazing opportunity. And for full-time university students, there is an academic program that you can find out about at the CREFC site. Lisa, to your point about this crisis, this period having been unique, and as you said, every period of weakness, of stress in the economy has a unique set of features. In terms of the disruptions to our ability to engage with one another, this has had some features that really distinguish it from the great financial crisis. What kinds of things has CREFC been doing over the course of 2020 to keep members engaged, to keep them informed, and to continue the dialogue with DC?
Sure. As you say, it's been challenging. Everything's a little bit easier through Zoom and also a little harder. There's nothing like sitting across the table from someone and having the conversation. So to the extent that obvious, everything we've done, be it within our own membership or with regulators, legislators, it's all been virtual on the phone in front of a Zoom camera. So to the extent, however, that the dialogue doesn't change, it's important in my mind that we get that intake from our members so that we can inform regulators, legislators on how we think things could be eased in some way. And so there's that, but there's also just the dialogue with our members to the extent that we've moved everything to virtual, our events. We've tried to respond very early in March. I think we had our first webinar on March 20th, when I had a panel of lenders similar to what we did recently at the Capital Markets Conference, just go through what was happening with their books, with their lending, with whatever it is that they focus on, be it an investor with securities, with a securities portfolio. And I thought that was extremely helpful. People were thoughtful. And to the extent that that's the kind of information we all need during a pandemic. The worst thing is that we all sit in our silos and not really sure about what's going on in the various components of the industry that affects your business. So to the good, I mean, it's certainly not a CREFC unique experience. The fact that everyone has got virtual, and yet I think most importantly, what we try to do every day is to put the facts in front of those who are seeking them, to make sure we've got those facts right and the ask right. And sometimes, we make hay and sometimes we don't. So I do think that we'll get into it, but there are some issues that we feel we have not been heard as well, or heard, and nothing has happened, however. And we're eager to make some progress on key issues like borrower relief, potentially rental assistance, certainly the stimulus bill. And I know we'll get into all of that, but to the extent that I think our voice has certainly been heard during this period, whether we've actually seen the response we're looking for, I would chalk that up to this is just a very, very difficult time for everyone. And knowing what the right thing to do is, who the right bodies are to help is part of the difficulty.
Yeah. So to your point about there being members of CREFC that represent every part and every feature of the real estate capital markets, we're now 9 months into into the pandemic. I think we all have our fingers crossed with what appears to be a highly efficacious vaccine. That if we can get the logistics of deployment right, that we'll be in a much different place at some point in 2021. But on the capital markets side, before we talk about sort of the legislative priorities and where we've made progress, or in other words, where we've been heard and not heard, how would you characterize conditions in the capital markets today? What does the availability of financing in terms of financing look like across some of the different capital sources?
Sure. I think from a macro perspective, we have our lenders are open for business. There are many who have, I think, expressed to me one of the key issues about lending today is trying to determine value, right? So I think to the good, what we found is post the great financial crisis, underwriting, lending standards in general became far more conservative. So these loans, I think, would have withstood many things, except for a complete stoppage in cash flow coming from certain property types. Certainly hotel and retail lead that charge, right? So to the extent that I think there's a significant amount of lending going on, it's the challenge is the valuations. So what's your LTV, but first and foremost, what's the value, right? And I think that goes directly to the lack of certainty as it relates to the pandemic. I hope and suspect that it will, between now and vaccinations next couple of months. It still seems to me that it's a good year away before people settle down, markets settle down, and you have some sense of what the future is going to look like. But that is further complicated by what is the country, what does the globe look like when it comes out of pandemic? There are many who believe we'll be in a significant recession and could be there for some time. Others think that it could roar back. And I think that is the challenge of lending in today's environment is how do you value an asset today amidst the pandemic what is its long-term prospects. I would say to the good, the new lending is important, but just as important is how lenders, servicers are dealing with existing loans. And some of the things that I find to be interesting about the pandemic is that by far and away from an economic crisis, I thought the great financial crisis was beyond anything I've ever seen, just in terms of the complete stoppage of markets and for an extended period of time. And so from a loan perspective, though, this pandemic has been quicker and faster to destruct than anything I've ever seen. From the perspective of loans, we had as much delinquent loans in portfolios 3 months into this pandemic. And in the great financial crisis, that took 3.5 years. So what happened in 3.5 years happened in 3 months in our market. And the difficulty there is that I think a lot of folks believed that this is a pandemic. We'll figure this out. There will be a solution. It's a medical issue. In a couple of months, we'll get back rolling. And so there were and continue to be a good amount of forbearance, modifications on loans. And some of those loans are going to make it as a result. However, there are certain assets where we continue to see markets close. And the second surge is certainly not helping on all fronts. But the reality is at some point, these assets and these borrowers and loans are going to unfortunately be in too big of a hole to move forward. Another surprising thing here is that we've not seen foreclosures really to the extent that we would have seen during the crisis. So I do anticipate, however, there's going to come a point where without any government assistance in any way, and this is why the stimulus bill that they're talking about today and hopefully be finished shortly with, is something that's so important because it will, to some extent, stave off some of those foreclosures. Unfortunately, as I said, at some point you are so deep in a hole that it's really hard to get out. And that's where we'll start talking a little bit about distress a little bit later.
So, and what you're describing with regard to how quickly we were able to observe that deterioration in the rising delinquency rates, not unique to commercial real estate either. I think that when we look at everything from the deterioration in the labor market and how quickly jobs were lost, and how quickly the Fed's balance sheet expanded, everything during this crisis happening at a breakneck speed that really sort of really tough to keep up with just how quickly everything has been moving. And then we arrive at this point in August, September, where we're hoping for and anticipating another sort of CARES Act 2.0 or another round of support for small businesses and unemployed households, and that in contrast going at the slowest conceivable pace. And here we are, at the mid-December, hoping to see more meaningful progress on that front in support of so many families. So when we've got a scenario like the deterioration in the hotel sector, significant increase in delinquency and default rates, if we're not seeing foreclosures, how are servicers and others, balance sheet lenders, addressing those issues?
Yeah, I think that's an interesting, I probably misspoke before when I said there's been no relief, because there has been pockets of relief, and that has actually been very effective. If you think about the banks and the life companies, they were given troubled debt restructuring relief. So from a capital perspective, from a risk-based capital perspective, providing borrowers with some form of relief wasn't extremely expensive on a risk-based capital. So to the extent that we found that worked well, right? And I'm seeing that, and it's good. I'm seeing that come from all types of lenders, even in the CMBS market. When you look at the number of forbearances and modifications that have been done to loans to date, it's surprising. It's more than you saw early on during the great financial crisis. And I think it has to do with the nature of this crisis. This is no one's fault. It's not a leverage issue. It's not a quality of anything issue. It's simply a stoppage in cash flow for these assets, again, through no fault of the borrower. And so you've seen that TDR relief. That is something we're advocating for under the CARES Act that expires at the end of the year. We'd very much like to see that extended. It's not like anything stopped. We still have pandemic out there, thank you. So let's address it. Let's continue to extend that relief to borrowers. The other side of it is on the sort of the GSE front. I think that they've been open kono in terms of lots of cash flow available to put to work in the multifamily sector. And to me, that's the most important. And it's certainly, they being willing also to forbear and to modify loans. So super important in that regard. And I do think that collectively, the lending community has allowed for a lot more time for people to try and to correct. And so that on the margin, that will cause foreclosures to be limited. And, as I said, there will be a modicum of these borrowers who unfortunately aren't going to be able to take advantage or have taken advantage, and it just hasn't been sufficient.
Yeah. I feel like during the great financial crisis, and there's certainly days from the GFC that, for me and I'm sure for others that, lived through it, it feels like it was just yesterday and not, 12, 13 years ago. But I think one of the questions that came up at that point, and we saw a lot of folks raising debt funds very, very quickly with the expectation that there would be a surge in foreclosures, opportunities to deploy capital at deep discounts relative to peak levels. But then the observation that the forbearance, the modifications, ultimately did play a bigger role in helping to stabilize the industry through the crisis and in the period that followed. Is that one of the lessons learned this time around, that although the triggers and causal drivers of the downturn are different, that there is value in being able to engage with borrowers and perhaps to move in a more reserved way towards a foreclosure?
Right. I suspect, if you think about the two crises, great financial crisis, we won't go into the causes. And yet I would argue that back then, all lending, regardless of type of lending, was a lot more aggressive than it was in this current cycle. So to the good, you went into this cycle with, a lot more conservativeness than you saw back then, lower leverage, higher coverage, all important in real estate. And so that certainly has helped and has sort of armed those borrowers and those lenders with a certain level of protection. And to the extent, and again, it goes back to the nature of this pandemic, if in fact you start to see improvement in the economy and a stabilization, and people can once again leave their homes June, July, August, whenever that's going to be, you will probably see a significant snapback for those who can hold on, right? And I think the fact that there's lower leverage, that there's a lot more money in these assets, that there'll be a real strong desire to do that from the borrower community, and for lenders to see that, hey, we probably may be able to turn this asset around and get it cash flowing again, and then therefore they can service debt. So it's very different this time around. I would say the past crisis was more an internal issue, where this is very much an external issue. And it really, I think the difference is, most, when they were forbearing or providing modifications early on in the pandemic, March, April, May, thought, 6 months and we'll be back at it. And I don't think anyone envisioned that this would take as long as it is and would last as long as it is, with the outlook, even with the vaccine now in motion, being another year. And so to me, that is where we are. That's the juxtaposition of a loan being able to continue to resume making payments, debt service, and finally paying off, and loans that won't. It is that duration of this pandemic that I think has truly changed the potential outcomes in a significant way for different asset classes and different borrowers.
So, to get us to the other side of this, if it is, a year away, which I think for a lot of people is the relevant time frame to think about when we'll have broad vaccination and normalization of behaviors, people, getting back into some semblance of your routine. And we'll see then at that point, sort of which of our pre-pandemic behaviors reassert themselves in force and which ones don't. And of course, big question in the office sector for exactly what that balance will look like in terms of CREFC's priorities on the legislative and policy front to help us get to the other side and for us to all still be here on the other side of it. What have those been?
They've been, I'd say the most significant ask of ours is some sort of borrower relief. I think that to the good, I was happy to see this movement in a positive way with the real estate focused trade associations coming together. It's sort of like a family experience. First, everyone gets mad, screams at each other. That you get it out of your system, and then you realize we are only going to move forward together, right? And so, to the extent that I think our GR department, all of them certainly helped in that regard to sort of cross that bridge to the other trades, mostly the borrower focused trades. And so once that happened, we very much focused, as did every one of our members. So the lenders, the investor, everyone sort of got together in a room and said, what can we do to ease this situation? Unfortunately, I think we came up with some interesting solutions. Because of the way in which CMBS is structured, we couldn't add debt. So none of the loan facilities that came through were able to work. And we decided that maybe we should ask for some form of preferred equity. Frankly, I think at the end of the day, it was too long of a bridge to cross with preferred. But it is the only way that we could have sort of delivered that assistance to borrowers directly. Since then, I think our focus has very much changed to rental assistance. And we've started to see some traction on the Hill with that because it makes sense. At first, I was a little bit hesitant because the administration of that seemed difficult. Ideally, if we were going to write this legislation or regulation, it would be something to the extent that the fund should go direct to the owner of the property, but must make rental payments. It just seems otherwise it goes to the tenant and then the tenant to the borrower, and it may be, to me, one way we can sort of get this bridge covered for at least for whatever period, 6-9 months, that we can proceed. So that's one form of relief. And again, we continue to advocate for the TDR relief for banks and the life companies. My sense is that the banks and life companies did a very good job of working with their borrowers, and yet having this modicum of relief in terms of regulatory capital was important to them. So that's been helpful. In the end, I think some of the other advocacy issues we had are more macro as well. They focus on, the stimulus package and the PPP program. Unfortunately for us, some of those loan facilities, as I mentioned, just simply didn't work. PPP didn't work. Main Street Lending Facility did not work. And so if I still believe that is our core ask. Do something for commercial real estate. It is a contributor to the economy. Data we show is that it accounts for about 18% of GDP. This is a business and an environment where you need all of that. And the one thing I think about is we've been watching retail deteriorate for a long periods of time here. If you drive through the country and you see these just sort of either dead malls or strip centers that have 2 stores open out of 15, that is not, I think, an America that we want to live in, right? We can do better than that. So to do what you can to hold up some of these folks, I think makes sense. And as I said, at some point, and this is when you don't want to sound like the evil lender, right? At some point, however, some of these borrowers and these loans are going to be so underwater that it really makes it difficult to hold on to that asset. And the good news, I think, is that there is capital out there to put to work for those assets. And so we're not there yet, and hoping that we elongate that stretch before we are there, giving everyone an opportunity to have this vaccine take hold, for things to start turning around, for industries and places to be opened once again. Those are the things that we need for these borrowers to hold on to their assets. And it's actually good for the entire economy. This is not a real estate issue. This is a macroeconomic issue as far as I'm concerned.
Yeah, you mentioned sort of the availability of capital. I think one of the narratives that we've heard in the industry for the last many years is that there is a tremendous amount of undeployed dry powder just waiting on the sidelines for
Yep.
its opportunity. Um, and that when that next downturn comes around, the sort of that dry powder will help to put a floor underneath liquidity values. Have we seen it at this point, or do we have to wait a little bit longer?
I'm sure, spots. No, but we're going to wait a little longer. I think there are a lot of almost many people I speak to are, hearing about distress funds being developed and the like. So to the good, the capital is there. But I don't think it's going to be deployed en masse just yet. There aren't those opportunities for that distress capital. And I suspect that's a good thing. There will be, and clearly, when you think about our asset classes, hotel and retail are really tough at this point. And yet you think about office, and I worry a ton, right? You have long-term leases in place right now. As those leases roll, what do our cities look like? And is there suburban, urban sort of shift back to, for a while there, you couldn't give away a suburban office asset. Now try to buy one, and so to the extent that we've seen this sort of whiplashing in the office market, and that's a bigger question. We talked about lending. We have folks, I think, on the life company, the banks, the debt funds, even the CMBS market, you were starting to see the lending tick up. And yet, clearly there was a period there where all lending stopped. So at the end of a year, come 2021, end of 2020, you're going to see volumes generally down for everyone. In the CMBS market, I just checked numbers today. Both the CMBS market and the CRE CLO market are down probably by half, maybe 45% or something like that, 50. And that's probably not untrue for the other lender types as well, because there was a period where you froze. There was nothing to do on a new lending perspective. The floodgate of loans that were having trouble, were where you spent sort of in sort of changed up where your focus is for sure. So I do think that if you go forward, the lending markets will continue to the good. Rates are where they are, right? And so you'll see some sense of normalcy return to lending, and I think it already has in many places, and that's going to be a good thing. But the question is, again, going back to value and how asset classes have changed. Have they changed temporarily or have they changed permanently? And so if you're always now your focus for the next 10 years is going to be suburban office, that does not bode well for New York and other major cities. And to the extent that there may be a sense that you will do better elsewhere, regardless of the urban setting, such as, for example, and I don't mean to throw out this name, but Goldman moving some component of their business to Florida. I wonder if we'll not see more of that for a variety of different reasons, right? But is this sort of trigger that gets people thinking about where they want to be and where they have to be?
One of the things that we've heard just recently in the Capital Markets Leadership Series last week, we were joined by one of the heads of that aforementioned investment bank, who described that they've continued to work on, albeit at a significantly slower pace, conduit deals, but SASB as well. As compared to the period after the financial crisis, where we saw a marked deterioration in volumes. How has this cycle looked? How does the cycle look? But also, so much of the concern back then was, oh my gosh, it's not just the immediate period of the Great Financial Crisis, but there's this tsunami. I think was the word of art that people were employing to describe all the refinancings and all the maturities that we'd have to manage for many years to come. My view is that we're in a very different place right now. To the points you made, leverage is lower. We don't have, a large pool of more challenging loans that will hang over us for another 5, 6 years.
Yeah, it's a distinction that you want to make between the previous crisis and this one, is that back then there were certain loans where you looked at almost from the very beginning, the day they came into 1 month delinquent, you kind of had a sense that this is going to be a tough one, right?
Mhm.
I think that certainty does not exist today. I think there is a growing certainty, but when I say you kind of knew it wasn't going to work, you knew that 3 months in back then. Today, it really is more of a wait and see kind of approach. And as I think I hate to phrase it this way, the winners and the losers over time are going to become more apparent. And to the extent that we have had an industry, if you asked me that we would be where we are today, and there's not a lot of foreclosures going on, I think a lot of that had to do with courts being closed, where they were just structural issues, right? But I don't believe that's the core issue. I think there are a lot of lenders who felt that, again, going back to pandemic specific, that they needed to give folks sort of that ramp. And so you'll start to see, as I said, it's just going to be a longer process this time around because there is this wait and see attitude. If you're starting to see more foot traffic at some point 3 months down the road, are you going to get up and running to the point where you were? And then a lot of that has to do with what's going on. I mean, I think there are a lot of mixed messages in the market right now. You look at the Dow and what crisis? Was there a crisis in this country? And then you look at treasuries, and the dichotomy between the two is like nothing I've ever seen. And that's different from great financial crisis, where you looked at the Dow, you knew exactly what was going on in the country. Today, this would be what? Pandemic? And so to the extent that that's a good thing in terms of, I hope the equity market slows down. We don't overreach if we haven't already. But that you don't want rates to rise dramatically. And I don't see them doing that because there's a ton of distress out there in all sorts of corners of the economy. And rates stay low, it does give the market an opportunity to do many, many things in terms of hard assets. And so that could be helpful.
So we have a sense now of some of the differences that we're observing in, operational outcomes, the fundamentals and the levels of delinquency or distress across property types, and it fits with our collective intuition that distress is concentrated at this point in the retail and hotel sectors. Again, they're the retail sort of having being in a period of transition and change long before the crisis, but the nature of the pandemic having very specific implications for those two asset classes. That being said, one of the other key differences that I think we're looking for is, and I'm curious as to how this is showing up in underwriting or the availability of debt, is when we're looking at sort of the New Yorks, the San Franciscos, the very big urban cores where dependence on the public transportation system, tax policy have presented headwinds for keeping businesses and people in town, for getting people to the office, no matter how careful we've been and sort of making our office places and workplaces safe. Are you seeing differences in terms of the availability of capital underwriting across both of these geographic dimensions, urban versus suburban, that you alluded to before, but also those biggest markets and that next tier that may be the beneficiary of some migration?
Yeah, I don't know if there's enough data to see that particular, but I think anecdotally that you're going to see more of it. And it think about populations and where those people live first, and then where the businesses, either they're following businesses or businesses are following them. And to the extent that we have a Biden administration, I'm hoping when I joined CREFC, it was September 2016, and 2 months later we had a new president, and that president was focused on commercial real estate, as well as is what I heard oftentimes was infrastructure, outer on the infrastructure front, because we really didn't see much in terms of better infrastructure. In some ways, this pandemic is going to cause that focus to be heightened. On the other hand, it comes at a time where cash is king, and are we going to be able to deploy capital in that regard? So if you can't do that and you don't see that benefit, sort of the benefit of infrastructure improvement, it's one more thing that would suggest that there will be a migration out of certain cities. Just even with school, with my office, my staff, I'm not comfortable with folks riding on a subway right now. And you have to ask yourself when, and is that going to get improved anytime soon? I mean, we've been, the New York City subway, it's gotten better, but it's now you have to wonder what it's going to look like coming out of the pandemic. But to the macro migration, I suspect that was happening a bit even before the pandemic. And this was sort of all the reason many needed to say, you know what, I'm going to make this move. And so to the extent that, again, we talked about lending, what we know, the life companies are lending, the banks are lending, CMBS market is lending. I think they're all doing less than what they were doing. But the uncertainty makes a lot of that lending somewhat dangerous, right? Because you don't know the answers to these questions. And so to the extent that an absolute winner of a trophy office in Manhattan, brand new, a couple of years old, whatever, leased up, all of a sudden becomes a significant risk. And so are you going to pile on to more of that, knowing that there is migration out of some of these urban areas or into, primary markets, into secondary or tertiary markets, in places where your employees themselves are saying, you know what, I'm tired of taxes in New York, I want to move somewhere else. So I do think that lending right now is being stymied to some extent, and because of the lack of certainty as to what the value of that asset's going to be when this 10-year fixed rate loan comes due. And you suspect that no one's going to refinance any of these loans given rates. So they probably have that kind of duration, in which case, there is a good amount of risk. Where there is duration, there is risk.
So I think we're naturally all big believers in New York and know that New York has an incredible capacity to recover, tremendous resilience. We've seen that time and again. But to your point, I mean, there are also real challenges that the city faces. Governor Cuomo just yesterday talking about the need for tax increases, where we're already, a very tax inefficient state. And are sort of internalizing the full weight of that inefficiency given the SALT caps for state and local taxes. We had Pat Foy, the chairman of the MTA, join us for the Capital Markets Conference a couple of weeks ago. I think he wanted to make sure that he communicated very clearly that the science shows the subways are safe. And they're taking extraordinary measures to keep them clean, to disinfect, and that people shouldn't the science doesn't sort of lend itself to or support sort of that feeling of anxiety, which naturally we all have. We're all experiencing some nervousness about using a system that certainly in the pre-pandemic environment, we all remember as being congested most of the time. And congestion just doesn't feel right now. Right. That's the whole message. Apart from those issues, though, the fiscal issues in New York, closing its budget, the potential for tax increases, taxing sort of those individuals that have the capacity to simply relocate somewhere else, because not everyone does have that ability. Compounded with deep budget shortfalls with the largest public transit authority in North America. The one thing he did mention that I think is going to be critical for us is that in terms of what I understand is the outcome of the presidential election, we couldn't have hoped for a better outcome in terms of someone who believes in public transportation, and whether it's Amtrak or the subways or light rail. But these are really big issues for us as we look forward to the next couple of years. When we talk about sort of renter relief or borrower relief in commercial real estate, one of the most tangible areas where we have seen intervention by government at different levels has been with eviction moratoria for residential renters. My own view has been that so many of our landlords in the apartment rental space are small landlords, and eviction moratoria without some relief for that small landlord as well is only half a solution.
Good question.
What do you see
Yeah, that has
happening in
been
this
somewhat of a
space?
tone deaf issue. Yeah. To me, the lack of a continuum in the thought process there doesn't make a lot of sense. You know, you have eviction moratoriums, you have, you know, sort of rent holidays, these types of things. Who's not going to support them? Who wants to see, especially in the multifamily space, people not have a home? That's obviously an issue and a concern. But on the other hand, there's no good outcome that comes from those types of moratoriums, because at the end of the day, you still have an owner of that asset, most likely with debt, who needs to not only pay expenses, taxes, insurance, all of that, but also needs to debt, you know, to pay their debt. So to the extent that it's somewhat tone deaf as to the continuum of how all of these things work, what happens when that borrower has to give back that asset for whatever reason? And I'm sure you'll find another, perhaps, but there's a period of time where this asset is going to deteriorate and the people living in that asset are going to suffer. So to the extent that I find it frustrating, David McCarthy and our staff has a state tracker. If anyone ever wants to go on the website and take a look, it talks about where we are on those types of issues across the country. You know, the activity in Oregon, for example, was extremely aggressive. And it does bring into question, how do you as a lender get comfortable there, lending on a go-forward basis, if something as extreme is passed in a state like that? And so I don't mean to pick on them, because you understand where they're coming from, right? However, this macro view is that you really want liquidity in that particular state, in any state. And so to pass legislation that really diminishes the ability to do that, for that liquidity to be diminished in any way, just is not a long-term smart kind of thing to do. And yet it seems right at the moment for those who are engaged.
Yeah. So we have just a minute or two left. There are two things I want to ask you about. One is that, you know, CREFC has embarked upon a really important diversity and inclusion initiative. I wonder if you could tell us a little bit about that. I do want to again reinforce Lisa's point, whether it's to learn about, you know, if you're a full-time student learning about, you know, the academic opportunities at CREFC, or whether you're a member of industry, to take advantage and avail yourself of the extraordinary range of resources available at the CREFC site. Please do take a look. But tell us about the, you know, the diversity initiatives and undertakings, and then maybe to close us out, what's your general prognosis for 2021?
You didn't tell me you were going to ask that hard question.
Okay.
Okay, the diversity, equity, and inclusion committee is something that we started a couple months ago. What just floored me was the number of people who wanted to be involved in this effort. There are many ways to go about it. As a woman in this industry for many decades, you know, for a long time, the thought is that when I first started, it was rare to see too many women on a trading floor. And frankly, you know, if they were more on the administrative side. And capable, lovely people all, but so few of them. And to the extent that 25 years later, I see very different things in our industry, and that's a good thing. However, what I don't see is a lot of people of color. I don't see firms. I think there's much more of it now, but back then, there was no sense of providing a path for everyone to see a future in that company, right? There was no education that said, okay, we're going to get you up to this level if you didn't come in that way. And back then, if you think about securitization markets, they were new markets. So we were all learning as we went along. And in some ways, I think of securitization as probably one of the more accepting, because it was really always about ability, no matter who you are. And so to the extent that I think about that, then what happened in the interim to not have any people? So I walk around our Miami conference last year, and it really struck me that I saw no people of color. There was no diversity in this audience. There were a good portion of men, a lot more women involved, and that's all good, but it's not enough. And so I'm so tickled that we have such sponsorship of this committee. I wasn't sure what to expect. Not that I didn't expect folks to respond positively, but not to the degree they have. Our goal, in my view, is to try to become more involved with Black colleges and universities, to drive home. Honestly, my dad was a plumber, and I've said this often. Did I think about commercial real estate finance when I was a little girl growing up? Absolutely not, right? Absolutely not. And yet today, the whole goal will be to get into those colleges, get in day one, freshman, and have a discussion of what it is that we do. And we have an incredible network of companies. So to the extent that we can directly contact those internships, summer internships, whatever they are, and offer them to those students that, you know, you need to meet some specified requirement. But after that, this is the way I think you sort of maneuver through an environment that welcomes the move. And that's the good thing. That's, I think, the most significant difference is people want to move the needle here, and what they're looking for are ways to do it. So I'm really tickled about this effort. And it's one of those things where as you get older, you want to do good. And hopefully this has some impact.
It does. And we're also really grateful at SHAC for CREFC's support of our programs and the partnership that we've been able to develop in support of diversity and inclusion in our student body. So Lisa, whether it's for the partnership that we kicked off earlier this year, or your time today, the work that you've done on behalf of the industry and advocating for all of us during an extraordinarily difficult period of time, both you and the team at CREFC. Thank you for joining me and sharing some of your thoughts to everyone who's on the call. Have a safe, healthy, and restful holiday. Looking forward to seeing you again in the new year. Lisa, thanks again. We'll see you soon.